Okay, let's unpack this right away. The recent escalation in the US-China trade war has caused American markets to just bleed out. We're talking about a loss of over $50 billion in shareholder value in a single week.
In a single week. And that $50 billion figure, it's a jarring wake-up call. But for those of us tracking the sources, it's really the policy mechanics underneath that headline that demand a deep dive.
Right.
Analysts are not mincing words here. They're calling this the, and I'm quoting, most dramatic and comprehensive escalation of the U.S.-China trade war in modern history.
And that's our mission today. We need to break down the sheer scale of the tariff campaigns we've seen this year. We need to look at China's very targeted, almost surgical retaliation, and then explain why a growing consensus of economists is now warning that this whole trajectory could, plunge the U.S. economy into stagflation.
Right. And we've gathered the sources to give you that shortcut, to understand exactly how this economic war is being fought, and maybe more importantly, to answer the question, who is actually bearing the cost of all this?
Let's start with the campaign itself. The scale of the tariffs introduced under the Trump administration. I mean, where do we even begin?
It's been relentless. By October of this year, the average U.S. tariff rate on Chinese goods had already skyrocketed to a pretty astounding 47.5%.
47.5.
And what makes that number so powerful is that this tariff wall, it covered 100% of all imports from China.
So everything. Nothing was left untouched.
Nothing. The administration basically ensured every single product category was already getting hit hard.
But then it got worse. The escalation didn't stop there. We saw that peak hike in the spring, a moment that I think really caught a lot of market strategists off guard.
It did. On April 9th, a staggering additional 50% tariff increase was imposed.
50%.
Which brought the baseline tariffs on Chinese imports to an average of 104%.
Wow. I mean, historically, that's almost unheard of in a major global trade relationship.
It is. It's basically a near-complete severing of normal commerce. And as you'd expect, Beijing did not hesitate. They fired back fast.
With matching tariffs.
With matching tariffs of 84% on American goods. And they aimed them specifically to price U.S. exports right out of their huge consumer market.
And the markets, they just reacted violently. Looking at the sources for October 10th, that one day, right after the announcement, the reaction was immediate and it was severe.
Oh, that day was brutal. The S&P 500, which gives you that broad snapshot of the U.S. economy, it plunged 2.71%.
Okay.
The NASDAQ, which is home to all those tech firms that rely so heavily on global supply chains, it crashed even harder, down 3.56%.
And the Dow?
The Dow dropped 1.9%. We're not talking about minor turbulence here. That single trading session wiped out billions in shareholder value.
And the reports all confirmed the volatility was because investors were just caught completely off guard. It just signals this deep, deep uncertainty.
Exactly. And that uncertainty is the real market driver. It's not just tech stocks. The volatility is systemic. It's hitting major retailers like Target and GAP, manufacturers like Western Digital.
Because they're all connected to China in some way.
Right. They either rely on importing Chinese components or they rely on selling their finished products to Chinese consumers. The market just sees risk coming from both directions.
Okay, this is where we have to transition from the action to the consequence. Because there's this huge misconception we need to dismantle. How do tariffs actually work, and why is the data so overwhelming that they're backfiring on the U.S. economy?
It's a crucial point. Because when you hear officials suggest that China pays the tariffs, they're fundamentally misrepresenting how the mechanism works.
Right.
Debunking that idea is essential. When the U.S. government imposes a tariff, that duty is collected at the border, and it is paid by the American importers. It's a tax on U.S. companies.
So let's use the simple example from the research. A U.S. retailer orders, say, $100 worth of goods from a factory in China. If there's a 25% tariff, that U.S. company now has to pay $125. The extra $25, that goes straight to the U.S. Treasury.
Precisely. The $100 still goes to the Chinese factory. But the U.S. importer is now on the hook for that extra $25. And that importer has, basically three choices.
Okay, what are they?
They can absorb the cost and just take a massive hit to their profits. They can pass the cost directly on to you, the American consumer, through higher prices.
Which is what usually happens.
Which is what we're seeing.
Oh.
Or they can spend a ton of time and money trying to find a new supplier somewhere else. In reality, it's a mix of all three, and none of them are good for the U.S. economy.
Let's talk about the concrete impact on households, because the data here it's pretty striking.
It really is. The Tax Foundation ran the numbers on these 2025 tariffs. They found that these duties amount to an average tax increase of $1,100 per U.S. household this year.
$1,100.
And it's projected to rise to $1,400 in 2026 if the tariffs stay. That's a direct hit to your disposable income.
And when you layer that on top of the inflation we already have, you can see why budgets are straining. And it shows up in the CPI, the Consumer Price Index.
It does. Research confirms the CPI has increased by 0.7% just since March. And that increase is directly attributable to the cost of these tariffs. It's a measurable, policy-driven hike in the cost of living.
And this isn't just theory. The St. Louis Fed has confirmed it. A huge portion of the cost gets passed right to the consumer.
Yeah, we have that one real-world example of a family in Michigan,
Yeah.
working-class family. They reported their monthly budget was stretched by over $200.
$200 a month.
Just from increased costs on everyday things. Items that might say made in USA on the box, but they contain Chinese components that are now subject to that 104% tariff.
So American consumers are paying more, but the pain is doubled for the U.S. businesses caught in China's retaliation.
Oh, absolutely. China's response was not random. It was, as you said, surgical. It was designed to cause maximum pain in key U.S. sectors. They specifically went after $21 billion worth of U.S. agricultural exports.
Which is just devastation for the heartland. There's that story of the Johnson family in Iowa, soybean growers.
A major soybean operation.
Right. And their exports to China made up 40% of their revenue last year. 40%. Now they're quoted as saying they're just sitting on grain we can't sell.
Because the tariffs made them uncompetitive overnight. Their soybeans are suddenly way more expensive than soybeans from Brazil.
And it's not just big agriculture. The disruption cuts across the whole economy. Small businesses.
The backbone of U.S. employment. Look at the example of Sandra Martinez in North Carolina. She has a 30-year-old furniture business.
Right.
She imports specialized hardware, specific fabrics from China, not because she wants to, but because the U.S. alternatives are either 3 times the price or they just don't exist anymore.
So when the tariffs hit, what happened?
Her cost went up 30%, almost overnight. A small business can't absorb that kind of shock. She tried to balance it, raise your prices by 15%, absorb the rest.
And her sales
dropped by 40% in 3 months. The source says she's now seriously considering closing the business her father started.
And that story just perfectly illustrates the problem. The cost is paid twice. It's paid at the register by the family in Michigan, and it's paid in lost revenue and lost jobs by businesses like Sandra's.
Exactly.
So let's zoom out. We've seen the impact on individuals and small businesses. What's the macroeconomic reality check here? What is this doing to the entire U.S. economy?
The macro view is very concerning. The Yale Budget Lab ran detailed models. They found that these 2025 tariffs are projected to slow U.S. real GDP growth by 0.5 percentage point.
0.5% for both 2025 and 2026.
Correct. And that isn't just slower growth. That means hundreds of billions in lost potential output. It means stalling job creation. And long run, they project the U.S. economy will be persistently 0.35% smaller than it would have been otherwise.
To understand the scale of this, we need historical context. The sources point out that the average applied U.S. tariff rate has exploded to an estimated 27%.
And that 27% figure is deeply, deeply worrying to economists because it's the highest level we've seen since before the Great Depression. We're talking about parallels to the Smoot-Hawley Tariff Act of 1930.
For listeners who only know that name, Smoot-Hawley, why is that parallel so stark? What's the warning from history?
Well, Smoot-Hawley raised U.S. duties on thousands of imported goods to protect American businesses. But the critical lesson is that it triggered immediate, massive retaliation from our trading partners.
A global trade war.
A global trade war. This tit-for-tat dynamic led to world trade collapsing by a devastating 65%. It didn't protect the economy. It profoundly deepened the Great Depression.
So the sources are warning that the exact same mechanism, aggressive protectionism leading to systemic retaliation, is playing out right now.
Exactly. And this whole environment raises the most alarming question for policymakers today. What is the risk of the dreaded stagflation trap?
Stagflation. That's a term that brings up images of the chaos of the 1970s. Why do tariffs specifically create this particular economic hazard?
Because they hit both supply and demand in the worst possible ways. First, tariffs are inherently inflationary. They raise the cost of goods, which pushes consumer prices higher. That's the deflation part.
And the stag part.
That's the second effect. By disrupting supply chains and damaging exports, tariffs simultaneously slow economic growth. That's the stagnation part.
So you get rising prices at the same time you have slowing growth, which puts the Federal Reserve in an impossible position.
An impossible position. The Fed's main tool to fight inflation is raising interest rates to cool down demand. But if the economy is already slowing because of these tariffs,
Which are supply-side shocks.
exactly, then raising rates further risks pushing an already sluggish economy into a deep, painful recession. They're caught between fighting inflation and triggering stagnation. It's the classic 1970s trap.
And while all this is happening internally in the U.S., China is executing this long-term geopolitical strategy, one that seems designed to isolate America permanently.
This is the critical long-term consequence. While the U.S. is locked in this tariff spiral, China is actively changing the global landscape. They announced zero tariff policies for 53 countries.
53 countries.
And they pointedly, strategically, excluded the United States.
So they're drawing a line in the sand, positioning themselves as the reasonable, stable global partner while painting the U.S. as volatile and protectionist.
It's a brilliant move for Beijing.
Yeah.
They're showing the world they're still open for business, just not American business. And our farmers are watching competitors from Brazil and Australia rush in to fill that void.
And those relationships, built over decades, they don't just snap back if the tariffs suddenly disappear.
They don't. That loss of reliability is the real long-term systemic damage. Look at the housing market. The American Action Forum estimates tariffs on construction materials, lumber, steel, appliances, could mean 450,000 fewer new homes being built through 2030.
Simply because the base cost of construction is becoming too expensive.
Prohibitively expensive. And then there's consumer spending. Morgan Stanley projects that if these tariffs remain, consumer spending growth could slow by 1.2 percentage points over the next year.
Which translates directly into retail stress, restaurant closures.
A reduction in economic vitality across the board, all because families have less money left over.
And that leads to the final, harsh reality. The damage being done now might just be permanent.
It might be. Supply chains are complex ecosystems. When firms are forced to reroute, that involves multi-year contracts, billions in investment. Rebuilding that trust and reclaiming market share can take decades. This is starting to look less like short-term pain and more like a long-term, self-inflicted handicap.
So let's distill this down. For you, looking to cut through the noise, what are the 3 critical takeaways from these sources?
First, the undeniable economic reality is that American consumers and businesses, not China, are paying for these tariffs. It's showing up in higher prices and lost revenue.
Second, the economic damage is immediate and measurable. You see it in the $50 billion that vanished from the markets, and you see it in the very real historic risk of stagflation.
And finally, third, China is brilliantly using this moment. They're executing a strategic response, building zero tariff alliances that are actively isolating America and creating alternative trade partnerships that will last.
So at the end of the day, the sources suggest we're losing much more than just plenty here. We are potentially squandering America's reputation as the world's most reliable economic partner.
And once that reputation is gone, once other nations decide the U.S. is too unpredictable to rely on, what policies can possibly bring it back? That's the crucial geopolitical question for you to consider as this crisis unfolds.